Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on this afternoon's market action. All three of the major averages holding on to gain some optimism heading into tomorrow's inflation print. The hope there that inflation prices will continue to cool, which would lead to a less aggressive Fed. At least that's how the market is reading it so far. The Dow up just around 197 points. S&P up just about 1% today. The Nasdaq 100, the outperformer of the three, up well over 1% this afternoon. Taking a look at the bond market action. Once again, we are seeing yields pull back. The 10-year yield off another 6 basis points. A huge jump that we're seeing in crude today. Some concern or really demand, I guess, is the big question mark here. And optimism, though, about the reopening in China, that is going to boost demand. Also, the coming price cap on Russian oil. Some of the big reasons why we're seeing crude move to the upside today. We're looking at a gain of just over 3%. Taking a look at some of those individual movers, some of the leadership coming from the big tech names. Apple up just about 1.5%. Amazon, a real outperformer in today's action, up nearly 5%. You're looking at Microsoft and Google, both those named up well over 2%. Look at that sector action. Still, though, a bit mixed when you take into account some of the names that are in the green. We're not really posting significant gains there, with healthcare up just about 0.3%. Energy, XLE up just about 0.2%. Consumer staples in the red, but real estate, consumer discretionary materials, really the leaders today. We're going to talk about meme stocks a little later on in the show, but certainly a lot of green on your screen. A lot of this being led by GameStop. That's one of the outperformers in the action today, up just around 6%. Bed Bath & Beyond, once again, Dave, moving to the upside. We're trying to make sense of it, but 3 days of gains. And remember, just last week, a huge move to the downside on fears of bankruptcy.
Look at that AMC number, rather.
Yeah,
AMC
exactly.
up
Carvana
17.5%. You mentioned China. Tom Hayes coming up on the program. Very optimistic about what's happening in China, so we'll talk to him shortly. But first, let's get you up to speed now on the housing market, which remains, for the most part, frozen by these higher mortgage rates. However, a slight downtick in rates did see a corresponding bump in refinancing. The Mortgage Bankers Association seeing a 5% increase in applications to refinance a home last week. That's compared to last year, however, volume still down 86% overall. Mortgage application volume did rise 1.2%. The housing market, like the rest of us, eagerly awaiting tomorrow's CPI number. They don't necessarily go hand in hand, but it's believed that if we get a lighter than expected inflation number, we're going to continue to see relief in the mortgage rates, somewhere landing in that mid-5 range next year. I think, Shauna, the biggest story in housing was actually yesterday late afternoon. Wells Fargo announcing they're going to pare back their mortgage business. They were often the leader in this industry, which I think tells you a lot about the big picture happening with mortgages. When someone like Wells has said, I'm good, we're going to get out, it's going to be a long road ahead.
Yeah, it certainly
These little numbers, I don't make too much of.
No, and also it's very important to put it in context, that year-over-year drop that you mentioned, they're still down 86%. So yes, we are seeing a bit of an uptick, but we are still far from out of the woods yet on this downturn that we are seeing in housing. A lot of the forecasts out there saying that we're not going to see a significant uptick in housing inactivity maybe until the very end of 2023 or even the beginning of 2024. So certainly going to be a challenging road here. And speaking about some of those refinancing numbers, there's data out from Black Knight saying that at the current rate right now, just 270,000 borrowers would benefit from refinancing. Comparing that to the number that we saw pre-pandemic or in the middle of the pandemic, when the mortgage rates were less than half of what they are right now. Clearly, millions of Americans were able to benefit from refinancing. So still a very, very small group that would benefit from doing refinancing.
Yeah, most locked somewhere in the low to mid 3s. And I don't think we're going to see that number until, late 24, maybe 25. But I think things start freeing up. To your point, late 23, early 24.
Yeah, exactly. All right, let's get to another big story today. We want to get you up to speed on BlackRock, because the company cutting its workforce, asset management giant, planning to reduce its headcount by 500. Now, that's according to an internal email seen by Yahoo Finance. The layoffs impacting nearly 3% of its workforce. BlackRock is scheduled to report fourth quarter results on Friday. Shares today still in the red, despite that some of that cost-cutting efforts, off just about 0.7%.
All right, nearly 8,000 flights across the country have been delayed today after a critical FAA system failed in the early morning hours. The Notice to Air Mission Alert System, which is used to share real-time information with pilots, was back online shortly before 9 a.m. Eastern Time when the agency said, quote, normal air traffic operations are resuming gradually across the U.S. Here to discuss the fallout is senior aerospace, defense, and airlines industry analyst for Bloomberg Intelligence, George Ferguson. George, nice to see you. This is very concerning because, quite frankly, we don't know very much. The federal government hasn't really given us an explanation, so I'm left to ask you your theory remaining out there as a possibility of a hack.
Yeah, so I mean, I guess we've heard the federal government say it's not a hack. I would tend to want to believe them. These systems, a number of them, they are always trying to upgrade their older systems that have been migrating over the decades. And so my guess is probably related more to maybe some migration, some adjustments. I think it's probably more of that than a hack or something else.
So, George, clearly massive issues here at hand. Certainly, we need to see an upgrade here in the system. Talk to us just about what that entails and how long something like that would typically take.
Well, I mean, this is something you're not going to fix, in months. It's going to be, again, my guess is that this is a system that's been migrating for decades, and it's going to continue to migrate over time. You fix parts of it that don't work well. Some of the noise I've heard from the marketplace is, in fact, that maybe there was some recent changes to the NOTAM system, and they could have been the reason why it went down today. And I think you have to remember, too, the NOTAM system is something where information is put in from around the nation, from flight service centers, about problems that there might be closed airspace or equipment at an airport that may be inoperable, that would make flight a little less safe. And so it's got to be collected from around the country, brought to a repository, and then sent back out around the country to pilots that will be flying to those locations. So it's a pretty complex system. And my guess is that out of an abundance of caution, they probably shut the whole system down because you want to make sure it's all working, because you don't want to miss one little piece. You could have, again, sort of an unsafe flight. You don't want that.
I'm sure it was disconcerting, to say the least, for passengers aboard flights that were seeing what was happening, a ground stop, and told, hey, you can land, no problem, but no planes can take off. Why is that?
Well, I mean, I think, obviously once you're in the air, you can't stop the flight. And so then that's a function of just bringing that airplane back into an airport. And I think, once you enter air traffic control and communications with the tower, they can let you know whether or not there be any anomalies in the ground that you need to be aware of to be landing the airplanes. I think that this was a story about safety, and out of an abundance of safety, they shut U.S. airspace down. Air travel has become increasingly safer decade over decade. And I think, so I think at the end of the day, that's what we should all be more focused on than the delay.
George, is there anything to say that something like this couldn't happen then again very soon while we do wait for some of these systems to get updated?
Yeah, I mean, these things can always rear their head. And look, we saw some problems at airlines, over the Christmas holiday at Southwest, where a system broke down. They're always working on them. They're always fixing them. So there could be more in the future. I would bet that we're going to have plenty of, sort of challenges in the business in 2023. It's a hard business. There's a lot of variables inside the business, weather being one of the most important variables, and weather will knock out operation or hurt operations. And so systems have to get around that. So I would anticipate more problems. But again, I think it's a story about safe operations, and I think that was the important part of the story today.
Yeah, I do want to get quickly your take on Southwest Airlines. They were the most impacted, according to FlightAware. 49% of their flights delayed. That's more than anyone in their space. Do you get a sense they have started to put together what went wrong and started to fix that computer system? Are they going to be ready the next time a perfect storm rolls around?
Southwest is a very good operator, and it was very surprising to see what happened over the Christmas holiday. I am absolutely sure they're working hard to make sure that doesn't happen again. They're one of the largest airlines in the country, so it's no surprise that they were one of the most affected from this outage. But I guarantee you they're working on that problem, and I guarantee you it will get better.
Certainly a story that we are going to continue to follow. George Ferguson, thanks so much for joining us here. Well, we are just getting started on Yahoo Finance Live. Coming up, stocks off to a strong start in 2023. We will tell you what history suggests could be ahead for the markets. And a blue check mark may not be the only thing that you will be able to buy from Twitter. There's a new report out saying that something else could be in store. And another one of Elon Musk's companies, Tesla, reportedly mulling an expansion to its Texas Gigafactory. We've got the details for you. Don't go anywhere. Let's check in on the markets. We have about 45 minutes to go in the trading day. Still, all three of the major averages holding on to gains. The Nasdaq up just over 1%. It's the fourth day in a row that we're seeing gains there for the Nasdaq. The first time that we've seen something like this since September. So let's talk about what to expect going forward. We want to bring in Tom Hayes, Great Hill Capital Chairman and Managing Member. Tom, it's great to see you and great to have you here in studio. So a strong start to the year, which historically means that maybe we'll have a strong rest of the year. What do you think's in store?
Well, I think we came in with really low expectations. If you look back to the beginning of 2022, consensus was that we'd close the year at 5,241. We closed at 3,800. This year, consensus is that we're going to close 2023 at 4,031. So estimates are really low. Expectations are really low. And even looking at earnings, which starts on Friday, estimates are that earnings are going to drop negative 4.1%. However, if you look at the Atlanta GDP now, which tracks Q4 GDP, it's saying that GDP was plus 4.1%. As they say in Texas, that dog don't hunt. One of them is going to be wrong, and we think that estimates are really low, and it's going to set up the positive beats moving forward and more positive guidance than expected because people are very, very pessimistic.
Story of my life, man. Set the bar low. It's easy to jump over it. Been doing that for 30 years.
Low expectations is the key to happiness.
Where does the bottom come in with the S&P? Some are talking 3,000, 3,200.
You know, it's interesting you mentioned that. That's consensus, and I think when everyone's looking for the same thing is usually when you don't get it. and everyone's looking for a weak first half and a strong second half. I think the surprise of this year could actually be a strong first half and a flat second half, and that's going to be driven by earnings. And we have to keep in mind the Fed. You know, everyone's saying, oh, I'm worried. The Fed keeps talking hawkish. You got to believe the Fed. You got to believe the Fed. Well, the Fed told us last year that the Fed's funds rate was not going to get above 1%, and we ended the year at 4.25. This year, they're saying we're going above 5.1%. I would take the under. I would listen to the bond market, and the bond market's telling you that's not going to happen. And we have to keep in mind they're not going to send you an invitation in the mail, Dave, and say, hey, in 3 weeks we're going to pause, or in 12 weeks we're going to pause. You should buy equities now.
Jamie Dimon threw out a 6 bomb though yesterday.
Jamie
rates a 6.
Yeah, he makes money on the spread, but so I think you want to be buying these high quality companies when they're on sale. I know the last time I was with you 4 or 5 weeks ago, we were talking about Amazon. You couldn't give it away. Now you look at today, everyone wants Amazon. And businesses like this, Amazon has grown its AWS and its ad business by 300% since 2018. It's trading at the same price. It's doubled its e-commerce business, and no one could give it away. So we're looking for things like that on a selective basis. But I do think the surprise, based on positioning, based on sentiment, is going to be to the upside in the first half.
Yeah, Amazon certainly had a very, very strong start to the year. Tom, you also like emerging markets. You think the underperformer of the last couple of years, things are going to reverse course this year. Why do you like them, and what's going to lead?
Yeah, the last shall be first, right? And that's consistently the case. As a matter of fact, if you look at the asset class mosaic every year, what underperforms, what outperforms, it's very rare to see an asset class 2 years in a row down at the bottom, not get to the top in the next year. And that's what we've seen the last 2 years with emerging markets. What's the driver? The driver is you need to see relief in the US dollar, and we finally got it 2 months ago. The dollar is down about 10%. And if you look at history over the last 20 years, the last time you had these type of drops in the dollar, 2002 to 2007, emerging markets rallied 480%. 2009 to 2011, the dollar came down, emerging markets up 198%. 2016 to 18, 100%. 2020, 2021, 95%. The biggest weight is China. We love China. The crackdown's over. The lockdown is over, and they've just set GDP targets for this year at 5%.
You're buying that reopening is for real, and we're not going back to COVID zero again.
There's no going back. They've already basically got herd immunity, or the equivalent of. They're getting the medicines, the Paxlovids, and everything that they need to take care of their people. And they've been stimulating, believe it or not, since March. It just didn't take because everyone was locked down and they couldn't get out and spend.
So what names do you like there?
Oh, well, look, we've been buying Alibaba for months. We've been averaging down. Our last purchase was at $61. Our basis is higher. We think it's incredibly cheap. You can still buy it. Even it's rallied the last 2 months. It's rallied 98% off the lows. You can still get it at 2014, near the IPO prices. And the difference is revenues are up 800%, earnings are up 500%. Oh, and by the way, they've got 38% share of the cloud business in China. That's going to triple in the next 2 years. The cloud business and their share at 38% is going to add 66% of operating income to that business. So we really like Alibaba. That's a bellwether for China and emerging markets.
You're not alone. Goldman Sachs, Morgan Stanley both coming out this week saying that Alibaba was one of their top picks here for 2023. Tom, we're going to get earnings really underway at the end of this week when we start hearing from some of those big bank names. You mentioned at the top of the segment here that you think there's a little bit too much pessimism when it comes to fourth quarter earnings. What do you think we're going to hear from some of those big banks?
Yeah, well, it can't get much worse. I mean, they had basically no banking business last year. I think in Q4, though, you started to see some financings come in Q4. So the investment banking business might be slightly better than expected. Not materially better, but, you're coming off low expectations, the key to happiness. And that's what we have going into Friday. So I think the banks will be okay. I think you're seeing, you saw today the refinancings pick up. I heard you at the top of the show. And that's going to happen more and more. The 10-year yield's down to 3.5, down from 4.23. The market's saying, we appreciate the hawkish talk, but we know sometime in the first half of the year, the pause is going to be on. They will keep rates elevated as long as they can, so long as the economy doesn't slow. But you saw a very similar situation from 1995 to 1999. People say tech can't do well now because the Fed funds rate's going to get over 5%. What was the Fed funds rate from 95 to 99? It was 6.5, and they kept it elevated for 4 years. So I'd be open-minded that some of these companies that have been cut in half are opportunities moving forward.
Oh, how we forget. Great reminder there. Great Hill Capital, Tom Hayes, good to see you, my man. Thank you. All right, coming up, President Biden says there's one place Democrats and Republicans might be able to agree. Taking on big tech. We'll tell you about his new op-ed in the Journal. And meme stocks soaring today. We'll show you the moves when we come back.
Let's take a look at the meme stocks. Bed Bath & Beyond rallying once again today. The meme stocks are back in favor with retail investors. Taking a look at one of the leaders here as we pull up an equal weight chart. Bed Bath & Beyond up just about 52%. That's the third day in a row of gains. A broader risk on sentiment here fueling this rally. Another hard, it's very hard to make sense though of some of the action that we've seen in a name, especially. Just take a look at Bed Bath & Beyond. I mentioned the huge uptick that we're seeing in the name today. The chart is not pulling up, but over the last couple of days, we certainly have seen this momentum to the upside. We're looking at gains of just over 141%. Indeed, this was a name that said that it was going to or likely might be forced to file for bankruptcy. Not a strong investor thesis or something you would want to say in order to get investors on board. Retail traders, though, don't seem to be spooked by that. They're buying that. They're also buying AMC. They're buying GameStop here among the winners in this meme trade today.
Yeah, and you'd search for some reason, you search for some why did they do this. Look, initially Bed Bath & Beyond surged on the layoffs, which could actually be a justification, but those layoffs clearly are not enough to save Bed Bath & Beyond, who's going to close around 150 stores and is clearly going to file at some point. So this is just your typical meme trade. We thought those retail traders were going to go to the sidelines in 2023, but that's the other big picture takeaway is they appear to be back, not just the the stocks that are popping. Party City's the big one that's surprising to me. Is it now a meme stock, Shauna? It was up 118% earlier, I think it was Tuesday, and now it's plunged right back down. Another rumor that they could file.
Yeah, I mean, it certainly has been trading like a meme stock. And when you take into account so much interest in that name, when the future, at least the next several months, the next year or two, seems to be or likely will be extremely challenging here for this company. It's also very important for investors to realize, retail traders, that when you're betting on names like this, names that are in bankruptcy, names that saying that they could file for bankruptcy, it's a real risk here, because if in fact they do file for bankruptcy, a lot of times as retail traders are the last ones to be paid out during that Chapter 11 process. So you could potentially leave a lot of money on the table. Also, not to mention the fact that really it's hard to make sense in terms of how these names are trading, how they are going to be trading in the future. So you got to be ready to lose all the money that you're pouring in.
And you also got to peel back and look at Party City right now is trading at 31 cents a share. So we're not talking about a $20 or $30 stock. We're talking about a penny stock virtually. There was a report out of Axios that suggested Franchise Group could buy them, take them over, and that was responsible for a bit of a rally. But ultimately, my favorite reference earlier was this is not a meme stock rally. This is a nonsense rally, and that's what it feels like it is.
That's the best way to put it, a nonsense rally.
All right, good stuff. Thank you, Shauna. Okay, President Biden calling on Republicans and Democrats in Congress to find common ground and unite against big tech. Yahoo Finance tech reporter Dan Howley here with more on this. Dan, let me just say I'm a bit pessimistic that Republicans, less than 2 years out from a presidential election, are going to give the president a win on anything, let alone big tech, but they have begun to turn against big business, so maybe there's an opening.
Yeah, there's some common ground here, and I think one of the big things to look at is what Biden really laid out. He had three different areas. The first has to do with privacy, and in fact, he writes in this op-ed, we need serious federal protections for Americans' privacy. That means clear limits on how companies can collect, use, and share highly personal data, your internet history, your personal communications, your location, and your health, genetic, and biometric data. He then goes on to say that there needs to be responsibility on the parts of companies for the content that is allowed to be posted by users. That goes into Section 230. That's real red meat for Republicans as well as Democrats. And then there's the idea of getting competition in the tech sector, so antitrust. These are all things that both sides want to kind of get to work on. They just can't agree on why.
Well, yeah, and that's going to be the key issue here going forward. And also, how is big tech looking at this, just in terms of the odds that maybe we will see more regulation? The fact that GOP and the Democrats, yes, they want change, but they want it in different ways. That seems like a very good sign here, at least for the sector.
Yeah, for tech, yes. Obviously, towards the end of the year, they wanted to get some kind of antitrust action moving forward. That just completely fell on its face, right? Yeah. I don't remember hearing anything happening. So it's not like we're going to get anything coming anytime soon. It's probably going to come as, individual piecemeal parts of what they originally wanted. So maybe some kind of privacy regulation. That's been something that both sides have been talking about
Section
forever.
230 has been talked about by both parties.
Right. It depends on what they don't like from each side, right? Republicans say they don't like it because it hinders conservative speech. Democrats say they don't like it because it allows, hate speech. So it's these two sides. They both don't like it, but they can't agree on how they want to change it. And now, it's important to point out that Section 230 is the reason why the internet kind of exists as it does right now. So any kind of change at all would dramatically change the internet, at least here in the U.S., potentially around the world.
And investors not buying it. If you want to look at stocks, Alphabet up 3%, Amazon up 5%, Meta's basically flat. So they're basically saying, nah, we don't think this is likely.
Yeah, Dan, what do you think this means, though, for the M&A landscape for tech in the near term? Because certainly we've heard from a number of analysts, a number of market participants here saying that M&A is really going to be what drives some of this growth here in 2023. If President Biden, and taking directly from this op-ed, saying that we need to bring more competition back to the tech sector, you would think we're going to see more of a crackdown then on M&A.
Yeah, I mean, at least as far as the bigger tech companies go, right? I mean, I don't think Meta is going to be able to go out there and buy anything at all right now. They tried to get that VR company and they, They were basically just told no. I don't think we're going to see any kind of stop to the companies, the Alphabets, the Apples, the Microsofts. Meta will probably still be able to pick up some companies, but it's not going to be anything that would be in a space where they probably feel like it is under threat from the likes of the FTC. There's also, just constant action in that sector. It's not as though it's just those companies purchasing other smaller companies, though for those smaller companies, that's really just a big payday for them, and that's what they're aiming for. But I don't think that means that we won't see any M&A. It just means that Lina Khan at the FTC, and obviously Biden in the White House are going to be keeping an eye on it to see what companies want to do in particular.
Yeah, and the DOJ's antitrust as well looks like they're in step there. All right, Dan, stick around for us. Want to get your reaction to this. Elon Musk throwing more up against the Twitter wall and just seeing if it sticks. The latest proposal outlined in the New York Times has Twitter considering selling usernames to generate some new revenue. Engineers have reportedly discussed running online auctions for in-demand names. Now, Elon tweeted last month that he wants to free up some of the 1.5 billion usernames that have remained inactive for a year or more. As of now, Twitter's rules forbid the buying and selling of handles. This look on the 30,000-foot view looks like a good idea, but one that really tinkers with the margins. How significant could the revenue be for selling a few?
Or how many people would do it?
Right. I mean, maybe businesses. I just can't imagine what a generator
I mean,
is.
there's obviously the idea of businesses or celebrities maybe, but when we were talking about Twitter Blue, right, the $8 or $10 I think if you buy it through iOS. The big thing about that was it's a revenue source, but it was never, ever, ever going to be, a replacement at all for ad revenue, right? So, I mean, that's $10 a month. How much are you going to, expect for people to pay for this? I mean, there's some services where you can buy extras for, your account. I think Discord, you can upgrade your account and get special avatars. So it's not as though, same thing with Reddit, I think, I'm not positive on that. But the idea is that there are, things like this out there where you would try to purchase something that, gussies up your account. Maybe you are, a sandwich shop and you want Fat Sandwich. Maybe that's someone's name already. It's mine, by the way. But maybe you want that.
Fat Sandwich.
You got to pay me big time to get that. But so I think there's an opportunity there, but this isn't the cure-all to his problems. He spent $44 billion on something that he didn't want, and now he's trying to figure out how to get that straight, and it's just not working. And I mean, all the reports are negative. So I just it's going to continue this way, I think, until he can figure out the advertising aspect.
Yeah, and who knows whether or not this actually will be implemented. But I really think that it speaks to the larger picture of what we've all been talking about, just the dire straits that it seems like Twitter is in at this point. They're really struggling to diversify their revenue. They're kind of throwing everything against the wall and really seeing what sticks. And you got to question, I mean, we don't know what exactly potentially usernames they want to sell, but say it's everyone. I don't think I would be using Twitter. Outside of my job, there's no reason I would be on Twitter. So you think that it would have a huge impact on the number of users, which could then, you would think, also impact ad spending and ad revenue and what they're able to charge some of their participants out there. So I don't know. I could see this really backfiring here for Elon Musk. So it's just a report at this point.
Indeed. Dan Howley, thank you. Good stuff. Coming up, investors are doing their best to keep up with all the speculation surrounding the WWE. We'll have the latest from Vince after the break.
Time for our triple play. 3 stocks that we're watching in the final 30 minutes of trading. We have Expedia, the WWE, and Toll Brothers. Let's kick it off with my pick, Expedia. Oppenheimer upgrading the stock to outperform, boosting its price target to $120 a share. Analyst Jed Kelly making the case that the stock's current price does not reflect improvements that Expedia has made to its platform. Shares have dropped about 50% over the past year. Earlier this month, BTIG naming Expedia its top pick for the first half of 2023. All this, I think, points to the fact that the travel industry appears to be, at least from these early readings on Expedia stock, that it's going to be healthy and maybe consumers won't be pulling back their spending as much as we had feared in the first couple of months of the year.
And interesting to see investors sort of jump on Expedia there, but when you take a closer look at the note, bookings was also highlighted as the top pick in the in the online travel sector. From that note, bookings not really moving much on the day, though. So I think maybe, Shauna, just investors more excited about the upside in Expedia. Bookings a stock that over $2,000 a share.
Yeah.
So probably just a bit of a difference there. But one of Yahoo Finance's other top trending tickers today is WWE, following rumors that the Saudi Public Investment Fund would be buying the entertainment company. Shares initially opened the day higher on that news, but have since fallen back. Our Brian Sazi reporting earlier today that a person familiar with the matter says WWE has in fact not been sold. The tweet that initially said this was deleted off the internet, so we think maybe jumped the gun a little bit there. But all the speculation does come amid some shakeups at the top of WWE's ecosystem. In the past week alone, you've seen Vince McMahon return as the executive chair, while his daughter Stephanie McMahon resigned from her role as co-CEO last night. All of this, I think, Dave, just showing us that the idea of WWE being sold and looking for someone to buy them is very real. Yes. You've seen it in the stock price over the last year. The stock's up, I think, about 75% now over the last year. Yeah. Would be quite interesting if the Saudi Public Investment Fund, which we know runs Live Golf and has been a little bit increasingly interested in sports, did in fact buy WWE.
And has, quite frankly, a bottomless pit of cash. That stock is up 30% this year alone on that optimism for being sold. And my source, well aware of what's happening there, says this is flat out not true. Now, when pressed by source, do you think the Saudis are going to buy WWE? Silence. I do believe the Saudis are going to be the likely buyer here because they have more cash than anyone. There's already a relationship in place between the WWE and the Saudis. They've held events there. Vince McMahon has no hesitation about doing business with the Saudis. None whatsoever. I think you can keep an eye on Comcast, maybe Apple, maybe Amazon. I think Qatar also is going to enter the sports rights negotiations in the year ahead too. Bottomless pit of cash.
WWE also kind of the business model that Live Golf would want to be, right? When you think about the different characters within Live Golf, sort of trying to create those rivalries. A lot of sports leagues have tried to emulate what WWE does. Yeah. Interesting from that perspective.
I think WWE is a far better purchase for the Saudis than the Live Golf, which is going to inevitably fail. My play is Toll Brothers, Bank of America upgrading the home builder to buy from neutral with a $68 price target. That is well up from $54. Analyst Rafi Jadrosic writing, quote, in 2023, we are cautious on housing demand, especially in the first half of the year, but we see a more favorable setup for home builder stock performance for a few reasons. Now, chief among those reasons are mortgage rates, which have come back down from their peak north of 7 and should continue to see some relief throughout the year. Jadrosic also believes homebuilder valuations have already priced in weak demand and home price depreciation. Toll Brothers stock up just about 3% today and nearly 10% this year. Its biggest competitor, Lennar, also got a nice bounce today and is up 7% this year. So we hear a lot of bad news, Shauna, in the housing sector, but the home builders look like they may be starting to turn a corner because of what's priced in.
Yeah, Bank of America positive on a couple of those names.
Yeah.
You mentioned the stock, or mentioned the reaction that we're seeing in Lennar. They also upgraded Lennar today. They also upgraded Pulte Group. NVR is their top pick within the sector, just given the fact that that company has performed historically well when the housing market has been relatively weak or in a weaker position than it has been over the last couple of years. So it seems like things are going to improve for housing. I think the key question, and we have talked about it so many times, is just when, of course, rates are going to come down substantially, when we will see that 30-year drop to closer to 5, that 6% range, and then if in fact that will be enough to kind of bring some of those people who have been staying on the sidelines, some of those potential buyers, back into the market. We'll see.
All right, Josh, good to have you, brother.
All right, all eyes on the CPI report tomorrow morning. One way you can play the number, an inflation-sensitive ETF. We'll tell you about it next.
While the markets await CPI data for the month of December on Thursday, investors are looking for ways to avoid the sting of inflation. So how can you protect your money in this kind of environment? For more, we turn to Astoria Portfolio Advisors CEO and CIO John Davi, who joins us now for this ETF report sponsored by Invesco QQQ. Good to see you, sir. So before we turn to the ETF PPI, let's talk about what your expectations are for inflation, this all-important read tomorrow.
Sure. I think that, we'll have a softer print. I mean, the trend has been lower. If you look a lot of the forward-looking indicators, they've been all softening on the margins. So CPI kind of being lagged, historical. I think my expectation is that we'll have a lower print. So the consensus is at 6.5. The last reading was 7.1. So, it's kind of trending in the right way. And that's what the market wants. It wants lower readings.
And John, do you expect that trend to continue then?
Well, I mean, if I take a step back, so I was pretty bearish going into 2022. I'm not as bearish going into 2023, and here's why. If I think about last year, I felt like the risks to the market were pretty symmetric, meaning that I thought inflation would be higher, rates would be higher. And it was pretty easy as a portfolio manager of what you would need to do in that scenario, right? So you'd underweight bonds, lower your duration, have inflation fighting strategies like PPI, own alternatives. And that, I think you would have had a much different portfolio experience. So we had Astoria had a best year ever last year in terms of how we did managing client portfolios, for ETF models. This year going into 2023, I don't have that same sort of conviction in the sense that I think it's more asymmetric, right? So on one hand, inflation will go lower and that's good. The bull case is also that, things like we had this DEFCON 5 moment for stocks last year, right? So the average stock was down 25%. The average tech stack was down 35%. Unprofitable tech down 60%. So it's hard for me to see two back-to-back DEFCON 5 years where, the average stock's down 30. But the bear case for me is that, the terminal rate, is probably going to stay stubbornly high this year. And if you talk to some Fed governors or if you listen to what they're saying, 4% terminal rate, maybe even 5%. So I think that's a problem. So I think for investors, you kind of have to barbell your portfolio and start to tilt away from, the last decade's trade, which is large cap core beta. And that's kind of what we do with PPI. PPI is really like an amalgamation of what we think portfolios should be structured going forward.
Yeah, tell us how PPI has performed in this environment and your prediction moving forward this year.
Yeah, so PPI last year was a good year. It was up 4%. S&P down 20. This year it's up about 3.5%. S&P up about 3% too. But in my experience, I've seen commodities, kind of energy equities trading at 25 times earnings, and it's just a very unusual period now where, remember, for the last decade, nobody wanted to own cyclicals, nobody wanted to own commodities, commodity equities, natural resources. So if your view is that inflation is going to be stickier and higher for longer, which is what our firm view is, I think that bodes well for PPI, and I think there's still a very valuable place for it in people's portfolios. The PE ratio is 8, so S&P multiple is at 17. So you've got this margin of safety in PPI.
Yeah, John, the top holdings are in your fund: CNH Industrial, Steel Dynamics, Nucor, Marathon Oil. So a bit of a mix there. As we do see CPI and PPI begin to cool, like we have been talking about, how do you shift your strategy, your investment strategy within the fund then to accommodate the growth or the easing that we are seeing in 2023 potentially?
Yeah, so very good question. So I think inflation is highly nuanced, right? So you got to have this kind of skilled active manager that can kind of move along different sectors and asset classes depending on where we are in the inflation cycle. So, for us at Astoria and what we've done in the PPI, the Axis Inflation Sensitive ETF, what we've done, in recent months is like we've shifted, so we sold some of our equities. We had at one point, 30-35% energy stocks. It's now down to like 17-18, right? So I'm somewhat worried about the energy sector in the sense that, it's this crowded, kind of consensus long. We increase our exposure to precious metals. Gold is a big hold in. Gold historically always does well in a recession. Recession risks are increasing. I think you've got like this, tailwind with crypto blowing up. I think that's good for precious metals. So I think that's, something that we're doing also. Also within PPI, we're going overseas too, right? We're owning international stocks. So between banks, energy, industrials, materials, the 4 sectors that nobody wanted to own, that's very underweight in most 60-40 portfolios, along with owning commodities, commodity equities, tips are interesting. They're positive yielding now. So that, kind of amalgamation of what we think should be in people's portfolios and how they should be tilted, is kind of what we're trying to do in PPI.
All right, good stuff. John Davi, thanks so much for joining us here this afternoon. Well, coming up, Binance trying to add a little heat to the crypto winter. The CEO saying that he's looking to hire. We have the latest for you. And be sure to tune into Yahoo Finance's Real Estate Report special tomorrow beginning at 4 p.m. Eastern Time. You won't want to miss it. updates from FTX's bankruptcy hearing today, including the discovery of some investor funds. Yahoo Finance's David Hollerith is here with the latest. And David, give us the headlines.
Yeah, in a federal bankruptcy court today in Delaware, we learned that FTX's latest efforts to locate the assets for its estate, this is the bankruptcy estate, has been more successful, at least in the last month. Andrew Dietrich, a partner for law firm Sullivan and Cromwell, who's advising FTX, said in court today that the debtors had located $5 billion in cash, liquid cryptocurrency, and other liquid investments, which are valued at as of the bankruptcy petition date. And notably, of the $5 billion, it doesn't include approximately $170 million with the Securities Commission of the Bahamas that was valued as of December, or the end of December. And that amount in the Bahamas is mainly held in FTT, the exchange token that has plummeted since FTX has filed for bankruptcy. The attorney also said that they're underway to monetize 300 other non-strategic investments, which are less liquid. And they have a book value about $4.6 billion. He also added that the total amount of the shortfall between FTX assets and what it owes creditors still isn't clear. And everything that he said today had to do with the location of these assets, not necessarily whether or not they had been recovered.
And David, while FTX falls, another exchange is still on the rise. Binance today announcing it plans to grow headcount by 15 to 30% this year. Should this be concerning?
Yeah, right. This hiring strategy is, of course, the opposite of what most tech and financial firms are planning to do, especially in crypto. Since June of last year, we've seen almost every major crypto firm announce layoffs. And there's been several others over the past 2 weeks since 2023 has started that include US-based exchange Coinbase, who have laid off workers. And that's significant because Coinbase, who announced layoffs of 950 people yesterday, is more or less the best comparison firm we can have for Binance. But back to the company in particular, on the other hand, they have not announced any layoffs since crypto plunged in June. They have about 7,300 workers. And interestingly, recent analysis from Forbes has also shown us that the company has been bleeding money in the last 60 days. They've lost approximately $6 billion. And those measurements vary, could be less, could be more, but it averages out to about $6 billion. And, all of this has to say that the strategy is going to be pretty interesting to watch to see if it goes forward. Binance last year for crypto trading volume, spot crypto trading volume accounted for approximately 67% of all of crypto trading volume. So the company is enormous as far as trading venues in crypto goes. So they are big, but we'll want to see how this strategy moves forward and if CZ can actually hold to it.
All right, David Hollerith there with the latest on crypto. Thanks so much. Coming up, we're counting down to the closing bell on Wall Street. Stick with us here on Yahoo Finance Live.
We're minutes away from the closing bell. Let's take a look at some of the big movers of the day. Airbnb, it's a top trending ticker here on Yahoo Finance. Headed into the close, we're looking at gains of just about 6% today. Now, there is no specific news on Airbnb itself, but the travel sector has been in focus after Oppenheimer upgraded Expedia, a 6% gain today. And taking a look at what we have seen from the stock over the last couple of trading days, a 5-day chart showing us gains of just about 6%. Over the past year, though, certainly been a different picture with shares off about 43%. Another big mover today is Crocs. We're looking at gains also there of about 6%. Wall Street weighing in on the company after the retailer raised its fourth quarter guidance yesterday. A couple of firms here are now a little bit more bullish on the outlook here when it comes for Crocs, raising their price target. We didn't initially see the reaction in the stock yesterday, Dave, when we got the updated guidance from Crocs, but a couple of analysts weighing in this afternoon, and that's why we're looking at gains of about 6%.
In fact, it was quite odd yesterday to see the stock slump a little bit after the guidance and record revenues for $3.5 billion. The big win for them has been this Hey Dude shoes we talked a little bit about on the show recently. Wall Street investors really did not like the acquisition, but now accounts for about a third of Crocs sales, has grown some 70% since being acquired.
Yeah, it's pretty amazing. All right, let's take a look at a group of stocks here that are moving to the upside here. There's not so much individual stories, but an overall theme that we're noticing in today's action. Lucid Motors, Affirm, the meme stocks that we talked about earlier on in the hour, even Amazon, all up today on investors appear to be hopeful ahead of tomorrow's CPI report. All those names have been hit hard over the past year amid concerns of rising inflation, also an aggressive Fed. We're looking at Lucid Motors up about 10% today. Over the past year, though, an extremely different story, off just about 82%. The same with Affirm. On a daily basis, we're up just about 12.5%. The past year, we're looking at losses of about 86%. And once again, taking a look at a number of the meme names trading to the upside this afternoon. Bed Bath & Beyond, clearly the outperformer of the group, but we're seeing a handful of these stocks that we have tracked so closely holding on to those gains. GameStop up another 7% today. Again, it's hard to really determine the big driver here, especially when it comes to memes. A lot of the investor story around these individual names appears to be skeptical at best. But you're looking at gains for AMC up just about 21%. We're going to get to the closing bell on Wall Street.
All right, there's your closing bell on Wall Street for this hump day as the markets and, quite frankly, all of us await tomorrow's pivotal CPI data, and it's been a pretty solid start to this trading year. Look at the Dow up 268 points. The S&P gains almost 1.3%. And again, it's the interest rate sensitive Nasdaq that continues to lead the way, up more than 1.75%, 189 points continually, showing a great start. Surprising to this early year. Let's talk about the day in trading. Megan Horniman, Verdant's Capital Advisors Chief Investment Officer, Jeff Small, Arbor Financial Group President. Nice to see you both. Jeff, let's start with you. What do you make of this action today? In the last couple of days, are we optimistic about the CPI data?
Well, I think the market certainly looks like it's optimistic, but we've been in this range of bear market rallies where the 10-year note starts to fall, yields start to fall organically before any kind of rate news, and the market rallies. And then the CPI report comes out, inflation data is not good, unemployment data is not good, and the rates rise organically before the Fed does anything, and the market falls. And so we've been on this yin and yang for a while. So I really think we haven't seen the new lows that we're going to see because the market's never bottomed before a recession has started. Unfortunately, that's where we are today.
Megan, what do you think? Do you agree?
It's somewhat. I do think we've been stuck in this range, and I agree completely with the rationale why. It's really on the interest rate movements and the expectation for the Federal Reserve. Also, keep in mind that January does tend to be a bit of a good seasonal month as well for equities as we get past any tax loss harvesting and we move into the new year. But I am cautiously optimistic. I still think that we will retest and get down to some volatility, some more pullbacks in the market before we can say we're all clear.
And Jeff, you're optimistic about the first half of this year. Why not the second half? And do you think we'll retest those lows?
Well, I definitely think we will retest those lows. And it sounded like my companion there on the panel here agreed with everything that I said. She just said it in her own way. I'm just giving you a hard time, Wendy. I apologize for that. But no, seriously, for investors, though, the first 6 months of the year are a great opportunity for folks to get involved in some of the best stocks that are beat up the most, have the greatest growth potential. And that's kind of really what we have to do to modernize our money and kind of gear up for where we are today. And so from that perspective, I think we've got 6 months to do that before we really see the recession start to get a firm grip on the numbers. And that means we should take our time and not go all in at once. And so the next 6 months presents some unique opportunities. The second half of the year, it depends on if we have a soft landing or not. Is it going to be a moderate recession? Is it going to be a softer landing? Is the Fed going to look at lowering rates early, which the possibility is always there. If they were going to lower rates before the end of this year, or let's say maybe even starting in the third quarter, if the data look bad. But I don't see the Fed doing anything until we see the unemployment rate get over 4.8 to 5%. And that's really, it all depends on what layoffs are going to look like this year and what earnings are going to look like this year to dictate what happens in the second half of this year. Actually.
Megan, when it comes to earnings, certainly the outlook here has been pretty pessimistic. We're expecting a pretty substantial drop on a year-over-year basis. Do you think that's a little bit too pessimistic, or maybe do some of those revisions, are they going to be revised to the downside even further?
I think that for the full calendar year, there still is room for the revisions to come downward for the S&P 500. It just from taking season by season, naturally, typically we beat earnings expectations by a few percent. So we may say it's a little bit pessimistic for this particular earnings season. But I do think 2023 needs to come down. And where I disagree with my counterpart just a little bit is that I think the first half of the year is going to be the most challenging part of the year for the equity market and for the economy. I think the second half is where we can say we might, the Fed's going to be at a pause mode, not a cutting mode, at a pause mode. And that's where the market can then really start to look at the next phase of what will be a bull market. I think inflation will have peaked and have come down substantially. But I think this first half, we're going to have to pay back some of that pent up demand from a consumer standpoint. We'll see a softer consumer. And as we know, the consumer is the biggest part of GDP. So when the consumer softens, that's when you tend to see that weakness in GDP. And I think we're going to get that in the first half of this year.
Jeff, why do you see it differently in the second half? And if you could tag on that, give me a name that you like in 23.
Well, there's lots of great names up there, but one of the ones I like the most right now is Baba. You can almost buy them at a 2014 IPO price. They're just a little bit higher than that today. Their revenues are up over 800%. Their cash flows up over 500% since then. And I think that's one of the most beaten up tech plays that are out there. That it really is a generational move that we can make some serious money on going forward in the future, as long as the virus becomes something that goes at bay and it doesn't become a problem going into the future with China or the rest of the global economy.
So Megan, what are you advising clients? What do you think investors should be doing at this point?
So coming into the year, we were raising a bit of cash to have that dry powder. I think right now the key to success for 2023 will to have that flexibility, some dry powder to put to work, because I think the opportunities will be there. What we're looking at is from a contrarian standpoint, what's already been priced in, what's priced in that peak pessimism or priced in the expectation of the economic weakness that we see. Small and mid cap stocks are one of the areas of the market that we think are so beaten down from a valuation perspective and just price perspective that they offer opportunity. And then don't forget internationally as well. International equities, they actually outperform U.S. equities for the first time in many years last year. I think this might be a chance where we can see that turn, because the one thing the U.S. has against it right now, especially this year, is it's tech heavy. That's not necessarily the case internationally. And I think tech still has some room to decline further.
All right, Megan Horniman, Jeff Small, thanks so much for joining us here this afternoon. Coming up next, you can't help but notice higher prices every time you walk through that grocery store. Ahead, we will break down some of the ways food prices have been impacting the CPI report. Stay with us.
Americans can expect an update on the state of inflation in America on Thursday with the release of December's Consumer Price Index. Yahoo Finance's Brooke DePalma taking a closer look at what we can expect when it comes to the cost of food, and that is what's been killing people all year round.
That's right. Well, of course, the cost of food associated with a broader outlook at the impact of inflation. Of course, we're seeing higher prices. And so let's take a look at what Wall Street expects tomorrow morning. As far as month over month, they expect actually the inflation rate to decrease by about 0.1%, but year over year, still up 6.5%. Now, that headline CPI number there includes both food and energy. Now, of course, we are seeing the cost of energy actually trend down a bit. Crude oil prices are seeing below $80 a barrel. Of course, that helps with the cost of both transportation of food, of course, to grow and produce and package this food. Now, but if you take a look at the trend overall, if you take a look at January this time last year to now, you see this sort of increase and some sort of deceleration here. So, of course, consumers optimistic that we'll see a smaller increase of both food. That 10.6% increase year over year includes both food away from home and the cost of groceries, and consumer expectations particularly high. According to the Federal Reserve Bank of New York, their consumer expectations report, consumers expect that inflation will decelerate to 7.6% in 2023. Now, of course, we are still at 10.6% as of November 2022. So that is a far way to go in order to decelerate from that number. Now, of course, one thing to note, too, is an equity analyst that I spoke to, Arun Sundaram, he said that most food manufacturers enter into forward contracts or hedges for raw material needs, so it could take a year or so until they actually benefit from lower input costs. And so we might see those food prices to not decrease until the back half of 2023. So some way to go until consumers will see some relief at the grocery store.
Yeah, that might take some time. Brooke, what are some of the items that you're going to be paying close attention to? I know we talk so much about eggs and the fact that prices there have skyrocketed so significantly over the last year.
Yeah, well, let's first take a look at eggs, actually. Of course, that is a big something that both consumers and Wall Street taking a closer look at. If you see here, month over month in November, we saw a 2.3% increase, and year over year, 49.1% increase as well. Those numbers staggering. That was getting some deceleration there, but now tomorrow's report, both Wall Street can expect a higher number. Of course, that avian flu outbreak certainly taking a toll. In November, year over year, 2021, we had 329 million hens laying eggs, that is. But in November 2022, that number dropped by nearly 20 million, according to USDA. So less hens, rather, to produce these eggs, meaning higher prices. And of course, that flu outbreak, when that happens, these farms then need to essentially destroy their flock. Of course, some relief hopefully coming for both beef, veal, poultry, and pork. Economist I spoke to at Texas A&M, he said that he expects a decline for those protein categories to continue into December 2022. Of course, keep in mind, this is a read back a month.
Cardi B's going to be mad, man.
I'm going to be mad,
Cardi B's going to go off.
So,
yeah, talk about the everyday American getting hurt.
Yeah, it shocks me every single time, right? Brooke DePalma, thanks so much for that. Well, companies are starting to recall employees to the office after long stretches of remote work. Well, that means many more Americans are hitting the road for their commute. But at what cost? Let's talk about it. Analytics company IXIC is tracking congestion data from 2022 compared to 2021, and new data revealing congestion cost the average U.S. driver $869 in time lost. That's up $305 from 2021. In the most congested areas, the dollar value lost was much higher. People in Chicago lost over $2,500 last year alone. Miami cracking the top 5, costing drivers around $1,700. U.S. drivers spent almost $130 more at the pump in 2022 than the year before, Dave.
Yeah, inflation and high fuel costs driving the numbers. In LA, that number went up to $350. Overall, the average U.S. driver is losing due to congestion is staggering. Nationwide, per person, 51 hours are lost. That's up 15, more than 2 whole days as well. People in Chicago losing 155 hours in 2022 over 6 days. It's the second worst on the planet next to London and really getting close to London. Here in New York, we lost 117 hours, almost 5 days. This, my friend, is depressing. Makes you just want to stay home. Unfortunately, that is not an option for we Americans.
Yeah, it is very depressing. When we take a look at some of the cities here that have seen the biggest jump in trips to downtown, their downtown cities, Washington, D.C., a jump of 23%, Charlotte, Detroit, New York, San Diego, rounding out that top 5 list. Dave, this might hit a little close to home for you. Do you know the most congested area in the country? Did you read it?
I do.
I-95 through
Very
Stamford,
aware.
Connecticut, right up in your neck of the woods, which I'm sure you've been stuck in that traffic many, many times.
4 of the top 10 most congested areas in the country in Stamford, Connecticut.
Yep.
The number 1 didn't surprise me, but 4 of top 10 was a staggering number for a mid-sized town, but a huge route between New York and Boston, and it's just difficult. But the one surprise that I came out of it, in addition to that, was we are still well behind pre-COVID numbers. In 60% of urban areas, we're seeing congestion decline. So clearly people are not all the way back to the office, and I don't know if we'll ever get back to even 75% of pre-pandemic commuter levels. Yeah. So if there is a positive from it, it's that people are staying home more than they were prior to the pandemic.
Yeah, except for us. We're here. We're here 5 days a week. But also, just speaking of the traffic in the U.S., how it compares on a global basis, Chicago, Boston, New York were the top 5 in lost time here in the U.S. due to traffic, but also on a global scale as well. They were in the top 5. So it's not looking good for people in our area, New York and Boston, and Chicago, in the middle of the country.
You know, at least gas has come down. Again, that another number that was a bit of a surprise. They're only $129 more expensive at the pump for your average American driver. I thought that number would be double or triple. Now it is if you're in Los Angeles, but not as bad as I expected in terms of how bad gas prices have hurt Americans. All right, coming up, Tesla embracing, saying everything is bigger in Texas. We'll tell you about their plans for a big expansion in the Lone Star State. Stay with us. All right, let's check on shares of Tesla. Still down more than 60%, but nice pop today, up 3.68%. Today, the EV maker filing regulatory paperwork saying that it could begin expanding its Austin, Texas facility as early as this month. Senior Autos reporter Pras Romanian here with more. Presumably, this is the Cybertruck? I laugh because we've talked about this for years now. Is that what the expansion would be all about?
I mean, well, I would think it would be, right? So $775 million expansion plan, that's a lot of money. They're already building the Model Y. That's a big facility, but what else could they be doing there? I mean, Cybertruck's got to be a huge part of that. Maybe some powertrain stuff there too. Looking to kind of ramp that up there in Giga Austin. So, that's probably going to be what people are looking at as the expansion plans, but also they're expanding internationally too in Indonesia. Bloomberg reporting that they're in talks there to build a plant that would support 1 million cars annually. This is sort of a big deal for Tesla because that's sort of like only their third international plant. So you have that kind of capacity there. You have Elon talking about how he wants to have, deliver 20 million cars by 2030. So a lot of kind of big picture stuff there. So Indonesia might be part of that.
Do you think that's going to really move the needle on there? Because lots of questions about whether or not Tesla is going to be able to reach some of those long-term goals.
Well, if they're going to be hitting that 20 million cars by 2030, they're going to need more plants. And Elon has talked about how he wants 10 to 12 plants around the globe, putting out close to 1 million cars a year. That's sort of how you do that. And then with Indonesia, they want to actually have a plant there that produces, but also have plants that do stuff like supply chain support. So I think that's all part of the master plan. The big part is the demand there. Are we seeing demand there for that many cars? So I think that's what we're talking about here with Elon and Tesla. And that story is, can they support that demand and create many cars that they need for sort of that whole, the whole EV transformation that we're seeing.
All right, Pras Romanian, thanks so much for breaking that down. Well, speaking of Tesla, one of the stock's biggest bulls, Cathie Wood, has a new favorite stock in her flagship ARK Innovation Fund. Exact Sciences is now the top holding in the fund today, overtaking Zoom Technologies. The firm believes shares of Exact Sciences could reach $140 per share by 2027 as cancer prevention and screening services continue to push growth. Joining us now is the author behind ARK's research on Exact Sciences, Simon Barnett, ARK Invest Director of Life Sciences Research. Simon, it's great to see you here. So clearly you're bullish on Exact Sciences. Why, and what's a huge catalyst going forward?
Yeah, no, thank you for having me. So yes, Exact has become a top holding in ARKK, our flagship strategy, as well as our life sciences focuses strategy, ARKG. So for those who may not know, Exact Sciences is the creator of Cologuard. 90% of Americans over age 45 are aware of the brand. It's gone from being FDA approved in 2014 to just surpassing its 10th millionth unit this past quarter. And what people may not know is, in addition to Cologuard, Exact Sciences guides medical management for the vast majority of women diagnosed with early stage breast cancer in the United States. And together, these form a very high margin, 70+% multi-billion-dollar business that the company is reinvesting into an extremely exciting pipeline of assets.
Simon, are you bullish overall on diagnostics, or is it something Exact Sciences does specifically that others cannot match?
Yeah, Dave, that's a great point. So I think in one of the past slides, you mentioned that healthcare is traditionally a defensive sector. We know very well statistically how many cases of cancer, how many survivors are accumulating over time. So there's definitely an element of that is, very certain in the background and in the market. But Exact specifically has tremendous regulatory experience, a really broad scale. More than 90% of oncologists in the United States have ordered a test from Exact Sciences. So this gives them a great platform in which they can launch additional tests and continue to improve on profitability, which they just accelerated from Q3 next year to actually this past quarter ended 2022.
How significant is the upside for Exact Sciences in the next couple of years?
Right. So you mentioned the base case assumption for Exact over the next 5 years, we believe could be $140 per share. But our bull case, which is looking increasingly more likely after this week's report at the JP Morgan Healthcare Conference, is north of $200. And a lot of that is driven by the company's pipeline, as well as the profitability of the core business that I just mentioned. I think one of the most exciting things for us is the idea of multi-cancer earlier detection. This is a blood-based test that can screen for many cancers at the same time, the majority of which don't have any screening technology today. And we really think that moving cancers from later stage to earlier stage is a really important part to improve cancer mortality.
Simon, you mentioned the JP Morgan Healthcare Conference that's underway right now. You've attended this virtually. Just your big takeaways from the conference and how that shapes the life sciences sector here over the next couple of years.
Yeah, so the first few days, I think what's really been resoundingly true is that the pace of science and innovation really has not stopped. In fact, it's accelerated quite a bit. The pandemic was a forcing function that caused the healthcare community to really rally around options that were less invasive or cheaper so we could navigate all the difficulties that were really placed on us globally from the pandemic. And we're already starting to see effects of this. I think over this next year, what's really important is the deflation that's coming down in the supply chain of many diagnostics companies like we're talking about. You know, over the past 15 years or so, the cost decline of DNA sequencing, which is a key input for running these diagnostics, has declined from over $3 billion per human genome to now under 200.
I want to ask you about Teladoc. A rough year, certainly last year, but up 6% today, and up about double that year to date. Are you bullish on the year ahead?
Yeah, definitely. So not much change there in terms of our outlook. What we're really focused on for the company in 2023 is a few things. So the first is, we're really moving from this era where not a lot of people really knew about telemedicine or thought maybe it was just spot treatment for urgent disorders or urgent care rather. And what the consumer is really demanding now is this shift towards quality of care, longitudinal relationships, and really something that is holistic, that encompasses, urgent and chronic and behavioral care. So seeing the company continue to launch and actually win multi-product deals is really important to us, as well as our ability to actually see the company monetize its user base and improve clinical outcomes, right? It's not just about volume, it's about making sure that patients with diabetes are improving on their A1C levels and patients with depression and anxiety are improving upon those metrics as well.
Simon, what's your bullish case here for Teladoc, just in terms of how big of a jump maybe we could see over the coming years? Because like you mentioned, it certainly was a winner during the pandemic, fell about 70% over the last year. What's the potential upside?
Yeah, Shauna, that's a great point there. I think it's been a very challenging year for growth-oriented, equity strategies and a lot of the companies therein. So we haven't published an official price target for the company. I think that's something that we're working on currently. But the way that I would think about it is, and it's really impressive if you look over the past couple of years, 1 in 6 Americans is a Teladoc member, so it's a tremendous amount of scale. And in addition to that, and I think this is really resonating with investors in this environment, is the company is operating cash flow positive in the back of many companies that are quite small and actually not even close to getting to that crossover point.
All right, Simon Barnett from ARK Invest. Good to see you, man. Thanks so much.
Yeah.
Coming up, the state of the cannabis industry. I'll speak with Curaleaf CEO Matt Darin and TerraSend Executive Chairman Jason Wild together on the benefits of legalizing recreational marijuana and their optimism about the year ahead. Next. Connecticut is now the 21st state where adult use cannabis sales are now legal and live. I was there at Rise Dispensary in Branford, Connecticut Tuesday, along with Green Thumb CEO Ben Kovler there in the center as things kicked off 2023. 37 states now have access to medical marijuana, but while the plant is expanding around the country, optimism is not growing in Congress. Here to discuss the outlook are Curaleaf CEO Matt Darin and TerrAscend Executive Chairman Jason Wild. Very cool to have you both joining forces today. I don't think we've ever seen this on television, so it's a real pleasure. And Jason, we'll start with you. What is your level of optimism for the industry as we start 2023?
My level of optimism is high as it relates to the industry and the companies within the industry that are moving forward with their plan to be sustainable, profitable businesses without the benefit of any reform federally or tax reform. I think that there are a lot of good companies out there that are positioned well, but I also, because of the lack of progress that the industry made in the Senate last month or the lame duck session, I would say that there are also a lot of companies that are going to be essentially have-nots and may not make it to the other side.
Matt, the investor story has been bleak. Stocks have been pounded in 2022. Not much positive movement to start this year. How optimistic are you about the year ahead?
Look, it was certainly a disappointing finish to the year. The fact that safe banking did not get passed was a disappointment, especially considering that over 90% of the U.S. population is in support of sensible legalization, as well as the fact that not passing federal legislation is not hurting the large companies like Curaleaf and TerrAscend and those as much as it's hurting the entrepreneurs and those that are trying to get into the industry and the small business people throughout the country and the social equity participants as well. That's ultimately where not having federal reform is hurting the most. And I think it's important for people to understand that as we continue to look forward into this year and continue to push for some federal reform.
Yeah, Jason, safe banking repeatedly passes the House, but now it's in Republican control, so we can assume that has stopped. When do you think realistically we could see safe banking that allows you access to traditional banks? And give me a bottom line in terms of a year you think we could see federal legalization legislation.
So I'll start with the second part first. I think full federal legalization, I think, is probably at this point at least 3+ years away at a minimum. As it relates to SAFE or some of the benefits of SAFE, I think we're probably looking at some chance of it happening this year. But as you mentioned, the Republicans control the House now. Unfortunately, when the Democrats controlled it, I believe SAFE passed about 7 times. But now the Republicans control it, and that does not improve our chances. The fact is, SAFE was incremental, and the benefits of SAFE were incremental in the first place. I'm not sure that we necessarily need SAFE, but we certainly need some progress as it relates to what we believe are unconstitutional tax laws about the fact that cannabis companies can't deduct their operating expenses, and the fact that while these companies are operating on a state legal basis, that the federal government is still treating them as if they're violating the Controlled Substances Act. I think that that we need progress there, but it doesn't necessarily have to come from Congress. There might be some other routes to be able to get there as well. And I'm confident that we make some progress on that front over the next 12 to 24 months.
We do not hear enough about 280E and the effective tax rate the cannabis companies are paying. Matt, when do you think federal legalization could happen? And what is the number one thing you think this industry needs if it were to come from Congress?
Look, we talked obviously about safe banking and all the benefits of it. I think in terms of the value unlock and continuing to stabilize the industry, I do think rescheduling, descheduling, removal of 280E will be the biggest catalyst. And whether that happens this year, President Biden has already directed the relevant agencies to be doing their due diligence to evaluate what that looks like. Whether that happens this year or leading up into an election in 2024 is anybody's guess at this point. But the fact that that review is taking place, the fact that there is a growing recognition that 280E is unconstitutional and is ultimately not going to be sustainable for this industry, I think is a very important development and something that we're really pushing forward the conversation on. And I think in an environment where we're not paying 280E taxes, all of those flow of funds that can go towards continuing to invest in our business, invest in our people, invest in R&D, in the communities that we operate in, is going to really, I think, accelerate and continue to advance the industry.
Jason, New York has come online. California was expected to be huge for the business. It's turned out to be everything but, quite a disaster based on the size of the black market. Could New York see a similar fate?
I think New York has different problems than California did. In California, there was a very large cannabis industry that already existed, and the state was trying to bring all the illegal operators in and sort of build the plane while they were flying it. There was a lot of cultivation, obviously, in California. New York is different. There's a lot of illicit drug dealers selling cannabis in New York, but it's mostly product that came from other states. So different issues, different growing pains. I think New York is set up to be a better market than California.
Sounds as though consolidation is ahead this year. Matt Darren, Jason Wild, thank you so much. Have some breaking news to get to. Really appreciate you guys joining forces and talking with us today. Thank you.
Absolutely.
Thanks.
All right, Walt Disney announcing that Mark Parker will be named chairman of the board. Parker, who also serves as executive chairman of Nike, has been on Disney's board for 7 years. He replaces Susan Arnold, who has reached the company's 15-year term limit. And should companies weigh in on political and social issues? Americans are split on this. A Gallup poll out finding that 48% believe that businesses should take a public stance. 52% say that they should not. And if you break it down by age, you see Americans age 18 to 29, 59% saying that companies should take a stance, age 30 to 44, 51%. That number continues to decline. 45 to 59 years old, only 41%, 60 and over, about 43%. Breaking it down even further by party affiliation, 75% of Democrats believe companies should take a public stance. That's versus 40% of independents, only 18% of Republicans, which doesn't necessarily come as a huge surprise to me, Dave.
That's the number that matters to me the most, because I think the playbook as we move forward is going to be Republicans taking on big business and a bit of a change in terms of how our parties traditionally lined up. Republicans also pushing back against the Chamber of Commerce. Why? Well, we had Ron DeSantis really begin this fight against Disney and their pushback against the so-called Don't Say Gay bill in Florida. And many thought that was going away. It is not. Ron DeSantis brought this back just a few days ago. He has proposed legislation to end the special governing district that Disney has there in the state of Florida. This is not going away as a political issue and will likely pop into the 2024 presidential election with Ron DeSantis taking on Donald Trump. And this may be his signature fight that he wants to make with big business. And it's a really strange time at which we're used to Republicans staying out of business. No, they want all in, and they want to keep them from speaking out on political issues.
Yeah, certainly. And GOP has taken issue not only with what we've heard from Disney, but Delta opposing Georgia's restrictive voting laws last year, Citi paying for Texas employees to travel out of state for abortion. So we certainly are seeing more of a mix here. It will be interesting to see how this all plays out over the next few years. You mentioned DeSantis, 2024 really coming into focus here, and what exactly impact that will have, how he will frame that, I think, is a big question at this point, but we shall see. All right, well, coming up, we will tell you about Netflix's latest push into live programming. Stay with us. Beginning this year, retirees in the U.S. are able to save their money before taking required minimum distributions from their retirement accounts for a little longer. Congress passing legislation late last year raising the minimum age from 72 to 73. The minimum age raises again from 73 to 75 in 2033. While these changes are designed to help Americans save, it might not be all that it's cracked up to be. Yahoo Finance's Carrie Hennon joining us now to tell us why. Hey, Carrie.
Hey there. Well, you're absolutely correct. I mean, it sounds fabulous if you don't need the money right now, for sure. I mean, you can keep it invested. It can keep growing for you, all those great things. But here's the issue, Shauna. If you delay and you push it back, what can happen is that you're going to push yourself. You're going to have to take a bigger distribution when you do start taking your distributions. And that could mean a higher tax bill. And what a higher tax bill might also mean is it may impact your premiums on your Medicare and also Social Security, which all depend on what your income is. So it's something that people really need to pay a little bit of attention to. Now, of course, you can start taking money out of these accounts, your tax deferred accounts, your retirement accounts, your 401k, 403b, IRAs, when you're 59 and a half without having to pay that 10% penalty. But you can't leave that money there indefinitely. So the new law simply says, guess what? You can bump it up, not 72, it'll be 73. But remember this, you turn 73 this year. The new law goes into effect January 1st of this year. So if you turn 72 last year, you're still under the old rules. You still have to take your distribution, your required minimum distribution in April. If you turn 73 this year, then you can wait until next April. So that's the situation right there. But again, there are some repercussions that people need to think about because, the IRS does these required minimum distributions by looking at what the pot of money you have at the end of December of the year you're going to start paying, the year you turn 73, and divided by, they have a life expectancy factor. So just figure this, as you get older and you start taking it out, you're going to have to take a bigger chunk out.
Carrie, realistically speaking, how many people will benefit from this?
I'm so glad you asked that, Dave, because frankly, a lot of people, this is really for a very small segment of the population that does not need this money. Most people, actually, 1 in 3 people start tapping into these retirement accounts way, after they're 59 and a half, way before this 73 age would come into effect. And in addition, most people, the Treasury statistics show that 8 in 10 people take more than that required minimum distribution anyway. So because those are the factors involved, it's just the people who really have enough money. Some say, it helps the rich get richer, but however you want to look at it, that's kind of where it comes down. But there are ways that you can delay taking that required minimum distribution. And these are 2 quickies. If you continue working longer, if you're working past 73, most employers will allow you to keep adding to your accounts and stay in your retirement plan without having to do a required minimum distribution. Now, you would if you have an IRA or outside accounts, your retirement accounts, you're going to have to do it for those. But that's one way, continuing to work and push back having to take distributions. And secondly, a lot of people, not a lot, I should say, but many people consider doing a Roth conversion. So taking your traditional retirement account, moving it into a Roth. When you have lower taxes, say that between when you retire and your minimum in 73, if you have a lower income tax rate, then potentially you might be able to do that. And then you will enjoy the benefits of a Roth and not have to take any required minimum distributions moving forward.
And Carrie, we also understand that heirs to retirement accounts may also feel the sting of this provision. Why is that and how badly?
Yeah, that's a great insight because, if your life expectancy, if you're pushing it back, you are going to start, chances are you may have some left in your accounts to leave to your heirs. Now, as an estate planning thing, that's one tool, but your heirs are getting that at a period in their life that they're at pretty high tax rates. Maybe, they're in their prime earning years. So they're going to get hit with a tax bill for some of this as well. So it's worth considering on all angles. Talk to an accountant about what you're doing and see what's going to work out best for your situation.
All right, good stuff there. Carrie Hennon, thanks so much. Nice to see you. The Golden Globes were last night. The viewership for the controversial awards show hit an all-time low, drawing in only 5.3 million total viewers to the live show. That's compared to 6.9 million in 2021 and 18.3 in 2020. These numbers from Nielsen don't include numbers from Peacock, where the Golden Globes were streaming, or DVR usage, so maybe we'll see a little uptick later. Now, this is interesting because NBC, they took a year off with the controversy. NBC renegotiated their deal down from 8 years to 1. My presumption on the surface is they're probably not going to renew unless it's at a significant discount haircut. Did you watch last night? I did watch much of the night.
I'll let you guess. Do you think I watched?
I think you didn't watch a minute.
No.
I did watch just to see, because I thought we might talk about it here. The star of the show, with all due respect to the stars, was the piano player who kept starting with all the speeches, and all the people who were giving their speech said, no, shut up. Literally telling the piano player to stop. A lot of no-shows that actually won awards. The jokes relatively fell flat. This is not a real good look for the awards show platform as we move forward. But look, there's not a lot of live content out there that you can afford. Live sports is too expensive, so maybe somebody forks over some cash for this.
Yeah, I think the question, though, is how much they're going to pay, how much they're willing to pay here. You mentioned 6.25 million in terms of viewership, off 10% from 2021. That's not much higher than the 6 million that tuned in back in 2008 when there was that writer's strike, and they held a press conference to announce the winner. So that really puts it in perspective just how people are viewing these award shows today compared to how they were viewing them 15 years ago. And certainly seems like people don't want to spend the time and spend all those hours.
We're a post-award show.
We are. Because you can also just get the highlights on Twitter, on social media. It's a totally different ballgame at this point. All right, let's also talk about Netflix, because shares down slightly today, just about 0.1%, but we had a nice pop on Tuesday on a few upgrades. The streaming giant continuing to rule out live sports rights, which dominated television in 2022. They are, however, adding live award shows. So Netflix going all in, whose ratings have just plummeted. What we were just talking about, they signed a multi-year deal to stream the Screen Actors Guild Awards starting in 2024. This year's SAG Awards will air on February 26th and stream live on the Netflix YouTube channel. I certainly don't think that this is going to have a different result. It will be interesting to see maybe if a streamer would have more success with this. I don't know about that, though, Dave.
Not optimistic, but certainly the word live is interesting when you tie it to Netflix, because to your point, they have stayed out of sports, and Ted Sarando's saying, we're not anti-sports, we're just pro-profits. Sports rights are just far too expensive for Netflix. I am interested in how they do producing live events, and this will be the first one that we really get a glimpse at. Chris Rock will have a comedy special on March 4th, which will be another, but I think it's a good move, because I'd like to see how Netflix produces a live event and how many people tune in. They want people on the platform more hours. They need that. Again, I'm guessing they didn't pay a whole lot of money for this, and probably some interesting tie-ins with Netflix shows, so perhaps it makes sense.
Yeah, well, certainly. It'll also be a little bit more of a pressure-off situation in terms of their first live event, comparing that to what Amazon did with Thursday Night Football.
Yes.
So we'll see.
All right, coming up, James Cameron's Titanic is returning to theaters. We'll tell you why next.
Let's take a look at a couple of stock movers here after hours. We have a Disney and KB Home. Let's kick it off with Disney. Shares moving to the upside here in extended trading, up just about 1%. Now, the move to the upside coming after the company announced that Mark Parker has been named chairman. He's been a 7-year member of Disney's board. He's also the executive chairman of Nike and the former CEO of Nike. When you take a look at Disney here, up just about 1% in extended trading over the last 3 months. We're looking at gains of just about 3%. This change coming, of course, under new CEO Bob Iger, who recently returned to Disney. Now, Parker will be succeeding Susan Arnold. The street very bullish on Disney at this point. We have 28 buy ratings and only 5 hold ratings on the stock right now. Let's take a look at KB Home. That stock up just about 3.5% here after hours. The move to the downside coming after the home builder missed on earnings. They also missed on revenue. EPS coming in at $2.47. The estimate out there was for $2.87. Sales a bit light, $1.94 billion. The estimate was for $1.98 billion. And in terms of their full year guidance or outlook here for 2023 revenue, they expect between $5 and $6 billion. That would be down from 2022 when we had $6.88 billion. So again, some pressure on the stock in extended trading, off just about 3.5% over the last 3 months. So we have seen KB Home get some momentum with shares up about 27%, Dave.
All right, Shauna, thank you. Paramount out with some big news ahead of Valentine's Day. The streamer announcing James Cameron's 1990, nice little cameo there. Nice cameo. The 1997 film Titanic coming back to a theater near you. That's in celebration of the movie's 25th anniversary. A remastered version will be screened in 3D and 4K starting February 10th, Valentine's Day weekend. The film stars Leonardo DiCaprio, of course, and Kate Winslet as lovers Jack and Rose aboard the Titanic. The film won 11 Academy Awards. It was #1 for 15 weeks and was the highest selling film of all time before James Cameron's other film, Avatar, broke that record. Are you going to see it when it's re-released?
I don't know if I will go and see it just because it's over 3 hours. I did go see it when it was released for the first time back in '98, and I loved seeing it in theaters. The 3D aspect, I think, would be very interesting, would be very cool, would be a little bit too real, I think, for me in some of the scenes to be seeing that play out in 3D. But I think this is also an example of the box office doing all it can to attract people back into theaters. Re-releasing big hits isn't anything new, but I think it's critical at a time like this when some of these movie theaters are trying to do all they can to win back some people that haven't returned to the movies since the pandemic. So if you can get some of those people back in the theaters, they're going to be buying drinks, they're going to be spending money on food. It could be a win here all around. Are you going to go see it?
I love this movie. Obviously, that doesn't surprise you. Probably not. I don't think this is a movie that gets me back to the theaters. Amazing to see Leonardo DiCaprio there. He's 48 years old, but when I look out the rest of the year, I think, what am I excited to see? I mean, there's an Ant-Man coming. There's a Super Mario movie for the kids. I don't know. I think this is why I'm bearish about movie theaters. The Barbie movie, what's that? July?
Yep,
August?
and a few months away.
The Barbie movie.
That's going to be it for you? That's going to be the one that we've been waiting for.
That's it.
All right, we'll leave you with that today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here again tomorrow. Have a great afternoon.